Okay, Assalamualaikum and good morning, guys. Okay, uh, today's topics we learn about lending policy. Okay, this is a topic that we will cover in test 2. Okay, what is lending policy? What do you know about lending policy? Lending policy is very important. Okay, for the bank. It's a guideline for the bank, especially for the credit departments, the operation of the bank, so that they can refer um, when they when they offerings their loans to the borrower, okay, to the customer. Okay, so lending policy is a guideline for the bank itself, okay, the staff of the banks. Okay, but lending requirements is for the customer. Using lending policy, bank create lending requirement for different type of loans. Okay, basically we have this learning objective. Okay, so the main thing that you need to know about this chapter is about the factor of lending policy, the function of lending policy, and the most important, how bank do credit analysis before they granted a loans to the customer. Okay, lending, we have discussed this in the class. Okay, lending policy very important because it relates to the lending activities. So because the main activities of the bank is lending activities, so it is important because from the lending activities, bank can create their profits. Bank gain their profit using the lending activities. Okay, so that's why lending policy very important. So it relates to the importance of lending activities to generate income of the banks. Okay, lending activities also important because it main contribution of the bank objective. As you know, what is the main bank functions? Bank function is related to the granted loan and advance. Okay, you can refer to the previous chapter where for the previous chapter we have 5 main activity of the bank, which is the main activities is granted loan and advances. Okay, so if it's showing that it's very important because from the loans and advances for the lending activities, bank can create their incomes. Okay, and lending activities also important because to ensure the relationship between the customer and a bank. Okay, for example, if a bank they cannot offer the loans, which is their main activities, they cannot offer the loans, customer they cannot offer the loan because they don't have enough money in the bank. So customer usually they will find another bank. Okay, so to maintain the relationship between the customer and the bank, which is actually a source of income, so bank need to uh, maintain or to establish their lending activities. So basically, when we talk about lending policy, there is an objective of lending policy. So in short, okay, the bank has a lending policy so that uh, it relates to the bank's incomes. Okay, so that's why it's very important. So the objective of lending policy actually to ensure bank uh, can maintain or can increase or to protect their incomes, which is interest income, because it relates to the lending activities. Okay, so when we talk about lending policy, they should ensure that bank can avoid the non-performing loans. Okay, to by using lending policy also bank can answer the question how to decide whether this loan is a bad loans or is a good loans, and then Lending policy also can be a guideline for banks to ensure the bank not doing strict lending policy or too flexible lending policy, because either it's strict lending policy or flexible lending policy, it can affect the income of the bank. Okay, so it also highlights the objective of lending policy to ensure, okay, the liquidity level of the banks. Okay, because if bank doing too flexible of lending policy, too flexible makes people easy to borrow loan from a bank easy to lend the money to the customer. So lending more money to the customer, meaning you keep small money in the banks. Okay, so when small money, small cash in the bank, small fund in the bank, it will affect the liquidity level of the bank. So bank try to lend money more because they try to gain income more. However, if they not protect or not have a good lending policy, maybe they cannot collect back their money from the borrower. So maybe it will affect the increment of bad loan, the increment of loan defaults. This also can affect bank cannot collect their loans, cannot collect back their funds and reduce their income. Okay. However, if bank they have strict lending policy, also will affect the bank lost their income. Okay, because too strict of lending policy, bank try to do strict lending policy because they try to avoid bad borrower or default borrower. So they put high interest income, very difficult to get loan, very a lot of collateral their demands, okay, requirement. Okay, so this also can affect customer find another bank to get income, and last, bank cannot generate income because no customer lend the money, borrow the money from the banks. Okay, so even though they are strict and the liquidity level is okay in the bank, but they cannot generate income because customer find other bank because the lending policy too strict. Okay, so basically the objective of lending policy, they try to balance, okay, as a guideline to balance the profitability and liquidity. Low liquidity in the bank meaning low fund and higher risk. Higher risk, of course, higher return. Low liquidity because bank loan or lend the money, a lot of money to the borrower. Okay, so they perhaps low liquidity, high risk, high return, they can get more profit. However, possibility, loan defaults, bank lost their future income. Okay, so that's why when they have a clear guideline for lending policy, bank can trade off between risk and return, trade off or balance between liquidity and profitability. Okay, in maintaining or in managing banks operation, bank always check on their liquidity level so that they have money to lend to the borrower and increase the income, and they also have money, the adequate level of liquidity, they have money to fulfill withdrawal demand when depositor want to withdraw the money. In the same times, they should have money that in maintaining liquidity, they also can gain profits. That's what lending policy or objective of lending policy. Okay, try to maintaining liquidity, adequate level of liquidity, but also increase the profit. So when establishing lending policy of the bank, okay, they should consider several factors when they establish or when a bank writes lending policy as a guideline to their staff. Okay, so factors that influence lending policy is like capital positionings. Okay, maybe bank will have more flexible lending policy. Okay, if they have more capitals, because more capital meaning they can lend money easily to the borrower. Okay, so more flexi lending policy. However, they also will consider about the risk and the profitability when they create lending policy. Okay, so if they think uh, the loan is higher risk, especially for long-term loan, higher risk. Okay, why long-term loan higher risk? Because in longer period there is possibility the customer defaults, cannot pay back the loans. Okay, so when the high risk loans, okay, possibility bank will have a strict lending policy on, or strict lending policy for high risk loan. Okay, but if bank they focus on profitability, there is possibility they have a more flexi or less strict lending policy, so people will borrow more money from them, and then they will get more profit. Okay, so by looking at this, most of the bank they are not looking at the risk only, but they will look at the risk and profitability, and they will create the loan portfolio. So the lending policy focus on the loan portfolio, several type of loans when they aim to get profit. Combination of loan, so they will get combination of profits. Okay, so reduce their risk. So how the strict or the lending policy will develop based on what type of loan portfolio. Okay, and then stability of deposit also play important roles. Okay, because uh, you know that the fund of the bank to lend the money to the borrower from the deposit, the main source of fund for the commercial bank is deposit, right? So if bank have more deposit, usually they have more funds, so most probably they can lend the money more, less flexible lending policy. Okay, so if the more fund are based on from long-term fund, for example fixed deposits, okay, negotiable certificate deposit, meaning bank will lock the funds in the bank system are longer, so they can lend more money to the public, so more flexi lending policy. But if bank have a lot of fund, but most of the fund are from saving account, which is saving account always fluctuate, people can withdraw anytime, right? So maybe bank will have a strict lending policy, because they don't have really stable funds to lend the money to borrower, especially for longer terms. Okay, that's why they have strict lending policy. Okay, and another factor bank will check is about the economic situations. Okay, the lending policy of the banks depends on economic situation. They always sensitive to the economic situation, so the loan portfolio that bank create will be sensitive to the economic situation. For example, this year the interest rate very high, maybe bank will try to have lesser less strict lending policy, which is more flexible lending policy, because they try to lend the money as much as they can to the borrower, so they can get higher income from the higher interest rate. Okay, so this is how economic situation play their role. Basically, this is also related to the monetary and fiscal policy. Okay, the factor of monetary and fiscal policy, where um, if the government put more liberal for monetary policy or fiscal policy, more liberals, this can affect the bank's management have more flexible lending policy. Okay, for example, government want to increase the economic activities. Uh, what they can do, they need to increase the money supply in the system, in the market. So to increase the money supply in the market, so they can apply monetary policy, for example like reduce the statutory reserve requirement of the bank, reduce, so bank have more money in the system, and the more money they can lend the money to the public. So this is meaning bank will have uh, more flexi or less strict lending policy. Okay, and factor of number 5, bank staff and capability and experience also play important roles in lending policy. Okay, a good, okay, if a bank they have staff that have experience related to certain loan type or certain industry, so maybe most probably they will have a good lending policy on that industry. For example, if they want to borrow to lend the money to the agriculture sector or SME, so the experienced staff will create uh, either the flexi lending policy or strict lending policy because they have experience. Maybe based on the experience, the small business cannot pay the loan in short-term periods. Okay, so should be long-term period. So the lending policy must refer to that staff. Maybe they can flexi or less strict loan lending policy to the SME, to the small business, instead of shorter periods loans. Maybe they can offer long-term period loans. Okay, so that's how the staff of the bank influence the lending policy. Okay, lastly about local credit requirement. So lending policy will, even though lending policy they have similar lending policy for the a bank, because it come from the HQ, because commercial bank in Malaysia we have several branch, right? But it depends. Okay, even though they have several branch, but they also have certain or additional clause for the certain branch. For example, branch in rural area, so it also cover the lending policy guideline for the staff of the bank to lend or to approve the loan for the certain credit area. For example, for rural area, so at the rural area, what is their credit requirement, what people in rural area need for. They don't need credit cards, maybe they need personal loan, maybe they need agriculture loan. So so the lending policy will have a guideline for that local requirement. Okay, if they need more agriculture loan, what type, so they will, based on that, they create lending policy. Okay, okay, what actually is lending policy, what they have in lending policy. Lending policy is a document, a guidelines. Okay, so lending policy, loan policy, you can check in the internet other banks lending policy. Certain lending policy they write for the certain type of loans. Okay, but certain bank they have lending policy in generals. Okay, and then they have specifics. Okay, so basically bank their amend amend their lending policy based on annually. Not all the policy they amend every year, but every year they will improve the do amendment on lending policy, or any economic changes they also will improve the lending policy or will amend the lending policy, because based on the factor we talked prior than this slide. Okay, so you can read about what is bank return loan policy or lending policy. Basically they talk about statement, about the operation of or the management of credit, how uh, the authorizations of the credits, what is document they needed for the loan approvals. Okay, you can read this. And the next slides. Okay, basically, okay, in conclusion, um, uh, please read, okay, this slide and the next slides. Okay, slide number 7. Okay, basically in conclusion, um, loans bank lending policy, they have state or mention about the objective of lending, the objective of lendings to get profit and blah blah. And then they will also mention about authority lines, who are authorized to achieve this document, who authorized to approve the loans. Okay, and then they also mention about credit criteria. Okay, for example, car loan. Okay, what is the requirement? From that, they will do loan requirement for the uh, car loan. Okay, for example, working capital loan, business loan. What is the criteria? Okay, what is document needs? Okay, so that's what they stated in the lending policy. Next, lending policy also cover the procedure and controls, how to manage loan defaults, when we should declare the loan is NPL. Uh, do we need to control how we control the NPL, non-performing loan? Do we need to call the person that has defaults in payment, or we should do legal action? When should we, or when bank should take legal actions? Okay. And then most of the bank also have stated about staff loan in their policy, because certain times they are give several special treatment for the staff when they staff borrow money from the banks itself. Okay, okay, how they manage the staff loan. And then criteria for handling NPL, how to manage NPL. If the NPL cannot really NPL, so how they can reduce the NPL problem. Maybe they can sell the NPL to the third party, at least they can get some money from the NPLs. Okay, asset management, for example, asset management company. And how they decide about the auctions. If loan defaults for customer or borrower of the house defaults, maybe we can do auction for house, we can do auction for any asset collaterals. Okay, and then maybe also mention about the procedure of periodic review of credit policy. Okay, how many they should review their loan policy, every year, every 6 months, or depends on economic conditions. So also stated in that inside the loan policy. Okay, so anything related to the loans, okay, activities are stated in the lending policy document. So the staff of the bank can refer, okay, if they have any problem to the when they manage credits. Okay, okay, you can read this. Okay, please read by yourself, and basically I have covered already. Please also check the example of loan policy I upload in your Putra Plus. Okay, when we talk about lending policy, okay, lending activities. So what is the lending process actually? Lending process actually start with the loan applications. Okay, loan application, maybe it come from the customer, or maybe also it can also become from the staff of the bank. They are finding customer, so they are find customer, offer the loans. Okay, whatever they are offer the loan, still the customer need to, or the borrower need to apply, fulfill the requirement, provide the documents. Okay, so it's loan application. And then when they submit all the forms and the document requirement for loan, okay, bank will do credit analysis. Okay, the credit analysis, the function of credit analysis is to ensure um, the borrower can pay back the loans. Okay, borrower have good credit rating, good credit worthiness to pay back the loans. Okay, and then they make decision whether the customer, after doing the credit analysis, we will learn what is the factor bank do in credit analysis. Okay, we will learn later. Okay, so after they done credit analysis, bank will do lending decision to approve the loans or to reject the loan. Sometimes bank approve the loans, but they not really fulfill the loan applications from the customer. For example, the customer apply 100,000, bank approve the loan but only 50,000. Or customer apply the loan for 10 years period, bank approve the loan for 8 years periods, less than that. Okay, it depends on the banks. After they make decisions, okay, they are not giving 100% whatever customer apply. Some of the bank, they based on credit analysis, they will offer certain amount, and what is the, they mention what is the monthly payment and also interest rate after they make decision on the credit analysis. Okay, so after they decide, for example, to approve the loans, okay, to granted the loans, they need to ensure that customer have make payments regularly on time. Okay, they need to check on that, whether customer pay on time, monthly payments. Okay, no problem to pay their debts. Okay, and then if something wrong or bank have outstanding amount, they should follow ups. Okay, but this always an issue for the bank. Okay, some of the bank, they are really a good they do really good follow-ups. When customer default payment for 1 month only, they already taken action, call every a week, they call, and then they submit, or they email, they post the letter, and then even they also take legal actions. Okay, they give warning. Okay, so depends on the bank, but some of the bank, they only follow up after they know the customer did not pay for 6 months. So basically this they can set up at the system, but nobody check on the system regularly, system of the bank. Okay, so if let's say they follow up and they find the customer have difficulty to pay the monthly payment, the loans, okay, payment, they can do restructuring, call the customer, discuss with customer what's their problem. Maybe from that meetings, okay, they can restructure, try to reduce the loan payment, monthly loan payments, or try to lengthen, or maybe they hold for the certain periods. Like last times when we have MCO, right, they have what we call that, what is the bank moratoriums. Okay, moratoriums meaning bank allow customer did not pay for the 6 months or for 6 years, for the 1 year, because of and they also stop the interest calculation for the 6 month, okay, due to the MCO. So this is the action can be taken from the banks. Okay, but they need to have discussion with the customer first, and then if the customer reluctant to come to discuss to the bank, maybe bank also can visit to check whether the customer still exists or they're okay, and then suggest a restructuring. This is the step to ensure bank can avoid non-performing loans. Okay, okay, when a bank make decisions, okay, to lend or to reject after they do credit analysis, okay, there is a possibility they make a error in making decision. Okay, we can divide the error to two types. Type 1 is error, or type 2 error. Okay, type 1 error is making a loan to customer who will ultimately default. For example, okay, when they make or do credit analysis, okay, actually this customer cannot uh, cannot pay you. The credit officer check based on the credit rating, credit analysis, the customer is uh, not a good customer. They don't have enough cash flow, a good cash flow to pay back the loans. Okay, but somehow bank approve the loans. That's the meaning of making a loan to a customer who will ultimately default. This always happen when you have, for example, like you have friends, your friend try to apply loan. When you work in the bank, apply loan, and then you know already your friends not really have a good cash flow, but because of that's your friends, so you approve the loans to the customer. So that one is type 1 error. Another type 2 error, which is denying a loan to a customer who would ultimately repay the debts, meaning that bank reject the loans even though the customer actually good and can pay back the loans. Okay, because the customer have a good cash flow, but bank reject the loan. This is possibility, the reason behind this, because of um, the banks do mistake in do credit analysis, not do thorough credit analysis. So that's why they're making type 2 error, which is denying the loans to a good customer. Okay, meaning that you can pay the loans, but bank not approve your loans. Maybe bank did not check other than your salary. Maybe you have other source of income. So they just based on your salary. So due to that, they reject your loan applications. So basically, in lending activities, there is principle of lending for a bank. Okay, they need to fulfill this principle when they doing or they do lending activities. They should hold the principle of purpose, principle of payment, and principle of protection. What means of principle of purpose? Meaning that bank check properly the purpose of the loans, whether it's for good purpose or not. Okay, uh, so the loan are really a real concrete purpose. For example, uh, the person apply the loan for study loan, but the person old already. Uh, is he or is she really want to study, or she just need the money, so she just get application, um, application from degree or from the master programs, so they can use that to apply the loan, study loan, so they can use money for other purpose. So make sure bank need to make sure, okay, when they lend the money based on the purpose of the borrower. So it's clear the purpose of the loan, okay, because usually the purpose of principle, okay, the principle of purpose relates to the principle of payment. When bank sure with the principle of purpose, the purpose of the loans, okay, it will relates to the payments, okay. If the borrower want to borrow money because of certain purpose, how they will pay? For example, because it relates. For example, they borrow for the business purpose. Okay, from the business, they can get money to pay back the loans. That's the relates. The purpose can create cash flow. Okay, for example, when you finish your study, then you can get a good job, so you can use that money to pay back. Okay, so that's why we talk that principle of purpose are related to payments. Okay, a good purpose can be uh, uh, assurance for the payment of the loans. Okay, and lastly, principle of protection to the bank, okay, to get back their money. Okay, so they need to check uh, the first protection, okay, usually based on the cash flow of the borrower, whether they can pay back or not. The second protection, uh, second defense of the principle of protection is collateral. If bank uh, think that the borrower did not have enough, the cash flow itself, not bank not confident, really confident about the cash flow that borrower can generate, they will ask about collaterals. Okay, so this is because to ensure or to protect the bank itself, protect um, from the default customer, to protect depositor money, because bank lend the money using depositor money, so they should have principle of protections. So when bank lend the money, okay, lend the money to the customer, they need to think about liquidity and profitability. Okay, when we talk about liquidity and profitability, that for every type of loans, okay, for example, long-term loans, okay, long-term loans, bank will have higher profits because bank can lend the money with higher interest rate. The long-term loan, the interest rate is higher compared to the short-term loans. The higher interest rate because there is possibility higher risk. Okay, bank need to lend the money for longer period. That's why they charge higher interest rate. So higher profit However, this will affect the liquidity. Okay, if bank lend too much money for long term, the source of funds in the bank will be lower, low liquidity in the banks. Okay, high risk. Okay, so the liquidity and the profitability of the banks, okay, actually depends on the type of the loans. Okay, the based on tenure, short term or long term, based on the interest rate. Okay, if short term, bank will have more liquidity because bank can get back money in the faster periods. Okay, if the to maintain liquidity also, bank sometimes they will take collateral, because if the loan defaults, bank did not have funds, they can liquidate the collateral, auction the collateral to get back their money. So increase the fund in the banks and increase the liquidity at the appropriate levels. Okay. In managing liquidity and profitability of lending activities, okay, basically bank will do mix of loan portfolio. Okay, so they not only have a loan for household only, but the loan portfolio also are loan for the business. Okay, so the loan portfolio not only depends on short term, long term loans, study loans, business loans, okay, household loan and also business loan. So this can trade off the between, can balance the liquidity and profitability. Okay, because they try to reduce the risk related to the loan, to lending activities. The main risk in lending activities are credit risk. What means credit risk? Is loan defaults. The risk of loan defaults, meaning the potential of the bank to get lower return or lower income due to loan defaults. Okay, not credit risk mean loan defaults. Risk meaning bank get lower income or lower or lost their income due to loan default, due to customer did not pay the loans. Okay, market risk, okay, the bank get lower income or lost their income due to fluctuation of interest rate and the stock markets. Okay, for example, if anything happen in market condition, the interest rate will be changed. Okay, so this also will affect the bank's income. Okay, because if investor can get higher income in the financial market, in the stock markets, they will invest their money in the stock market rather than they invest money in the saving account of the bank, invest in any type of investment in the banks. So bank lack of their fund, lack of their source. Okay, this also can affect the fund bank can lend to the borrower and reduce their profits. So that's why market risk is actually the bank lost their income or get lower income due to the fluctuate in interest rate, the changes of market conditions. And another risk also related to the liquidity risk. Okay, liquidity risk and market risk is highly correlated. Okay, that's what I mentioned just now. When more people invest in market rather than bank, so bank have lack of fund. Lack of fund meanings bank have low liquidity, which is higher risk. Okay. Okay, in balance sheet, liquidity and profitability, this is the that suggestion you can, in conclusion, you can see here. Okay, the short-term loans, short-term loan is low risk. Why low risk? Because bank can get money in fast period. Less than 1 year, bank can get back their money. So when low risk, they can get quick liquidity. Okay, which is low risk because high liquidity. The level of liquidity high, not the risk high, the level of liquidity high, so meaning low risk. Okay, because liquidity level high, low risk. But short-term loan, the bank only can charge low interest rate, low profits. Okay, so low risk, low return. Okay. However, for the long term, bank charge higher interest rate because of high risk. Okay, high risk bank lack of liquidity. Okay, because longer period bank can get their fund back. Okay, less liquidity meaning high risk. Okay, high risk get higher return. Okay, higher interest, higher profits. Okay, so because more risk. So but the problem is liquidity concern. Okay, so in conclusion, the higher interest rate can increase the income of the banks. Okay, however, it's higher risk to the bank because it will affect the liquidity problems. Okay, there is possibility that bank cannot fulfill withdrawal demands. Okay, if loan defaults. Okay, we have discussed this in chapter financial statements. Okay, several type of loan that will be under loan portfolio of the banks. This is how they can use the loan portfolio to balance between or to trade off between liquidity or profitability. Okay. Okay, when we talk about the loan portfolio, the mix of loans in the banks. Okay, loan portfolio is mix of bank loans. Okay, how bank decide their loan portfolio? Okay, because they need to make a loan portfolio to balance their liquidity and profitability. So there is several factors that bank need to refer before they make decision on their loan portfolio. For example, more business loan or more household loan. If more household loan, which one loan is the priority? Personal loan, housing loan. Okay, how many percent of the loan portfolio come from the short-term loan? How many percent is long-term loans? Okay, all of these are determined by several factors, which is, for example, characteristic of market area. Okay, for example, if a bank in the city, okay, maybe their loans are more on the short-term loans, uh, credit card loans, because they are focused on the people on city. They need to buy credits, buy things using credit cards. This is example. Okay, if the bank is situated in rural area or industry area, so maybe their loans are more on industrial loans. Okay, working capitals, business loans. Okay, and lender size also can be factor of portfolio, loan portfolio. If bank, okay, this is there is argument in researcher, in article you can read. Some of them mention is the lender size, okay, mean bank size. Okay, if the bank is bigger, usually they have more loan portfolio. If the bank is smaller, they have low uh, low uh, loan portfolio. For example, if lender size, the bank size is big, usually they have more long-term periods loans. Okay, compared to the small size bank, they have uh, lower long-term loan because they don't have enough capital to cover a lot of long-term loans. Okay, and then based on experience and expertise of management also. Okay, so if they have a good expertise in the management team, so they will have a good loan portfolio that can manage their liquidity and profitability. Maybe uh, their management are very good in follow up. Okay, so they don't worry about to lend more money to the long term periods. Okay, long term loans. So that's how they manage their loan portfolio. And loan portfolio also depends on the expected yield of the each type of loan. For example, if the banks, they are focused more on getting a higher income, So the loan portfolio are more on loan that have higher interest rate. Means the loan portfolio majority come from the long-term loans. Okay, but if the aspect lower interest or lower return, lower yield, so they should go for low risk uh, loan mix portfolio. So meaning most of the loans in their portfolio are short-term loans. Okay, and another another factor that affects loan mix or loan portfolio is regulation. Okay, the regulations is very important. Regulation based on the supervisions. Okay, central banks. Okay, this is to ensure a bank's they produce efficient loan, not a bad loans. So, for example, regulation on central bank uh, re, um, need to fulfill the reserve, okay, to the liquidity requirements. All of this will affect the loan portfolio. Okay, if the regulation are compulsory to give a small business loan, how many percent? So bank need to decide their loan portfolio also need to have a part of small business loan. Okay, and lastly, the loan portfolio also determined by loan policy. For example, if loan policy allows need uh, focus on the higher income loan, so the mix of loan or the loan portfolio should have more uh, higher interest rate loan. Okay, or if the loan policy only allows um, agriculture loans, okay, and also industrial loan. So the loan portfolio only consists of agriculture loans, or bank can offer agriculture loans and industrial loan only. So it depends on the loan policy of the banks. Okay, when we talk about the regulation in previous slide, okay, regulation by supervision of the banks, okay, which in Malaysia central banks. So how bank should regulate before, or should focus or should base on regulation before they develop their loan portfolio every year or every month. Okay, the regulation they need to fulfill usually to fulfill to ensure they produce a good loans. Okay, produce a good loan meaning they can protect their depositor, because when bank produce a good loans meaning they can get back their money, because the money is come from depositor. Most of the fund of the bank come from depositor. Okay, so they can get back their money, so meaning it will protect the depositor money. Anytime depositor want to withdraw the money, bank have that fund to allow the withdrawals. So that's why uh, the loan portfolio need to follow the requirement regulations of the supervision of the bank, and the regulations are to ensure bank produce efficient loan, a good loans. Okay, so how bank decides the banks produce a good loan or not, they will based on CAMEL rating. CAMEL rating is capital, asset, management, earning, liquidity, and sensitivity. Okay, so bank will check on this. Okay, the central bank will supervise their commercial bank or their financial institution regulated by them to fulfill all these requirements in producing the loan. Okay, for example, usually the rating is based on number 1 to number 5. Maybe number 5 if the very good, number 1 is bad management. Then we check on capital of the banks. Okay, whether the capital of the bank, commercial bank, are good enough to produce how many loans. Okay, asset quality. Asset quality meaning the current asset, the current loan in the bank is how many percent is good loan, or is it very high NPL currently? They need to check. Okay, Management quality, what means by management quality? How bank management manage their asset, manage their liability. Okay, earning records, the bank performance. Okay, liquidity position, it relates to the asset sensitivity to liability sensitivity, meaning short-term asset and long-term asset. How bank can maintain their liquidity position, can they fulfill the liquidity requirement to fulfill the withdrawal demand, for example. Okay, and then sensitivity to market risk, how bank can manage their risk when interest rate changes. Sensitivity, because sensitivity relates to the short-term interest rate, short-term interest rate to their loan, short-term interest rate to their asset, short-term interest rate to their liability. So how the changes of interest rate affects banks, how they manage or what their risk management tools to reduce their market risk. Okay, so bank will checks the supervision of the bank, central bank will check on this camel rating and then make conclusion about the performance of the banks. Okay, so from that, then the BNM or the central bank will allow a bank to increase their lending activities or to need to reduce their lending amounts to the borrower. I mean the total lending amounts. Okay. Okay. Please read these slides. Okay. Example. Okay. This is from textbooks. Okay. Okay, this is from the camel rating just now. You can see this one. Okay, when you can see this one, this is how they rate based on the capital adequacy. If the bank get all 5, meaning the bank have very bad management of their loans, so it can affect the central bank limited their lending amounts. Okay. Okay, this is how the lending process. Okay, you start with the loan application, finding the customer, and then when you find the customer submit the loan applications, and then when they submit the loan application with the with the loan documentation, any evidence they support, then bank will do their credit analysis. They check on the character of the customer, check on the credit record. Okay, check on the financial cash flow. Okay, this is to ensure the customer can pay back or have cash to pay the loans. Okay, so and then they will check on the protections, whether the customer provide any extra protection to the bank, provide possible collateral. Okay, so sometimes the customer can get easily a loan when they have more collaterals. Okay, meaning they are willing to pay. Okay, then after that, bank will do monitoring if they grant the loans. Okay, so in doing credit analysis, basically bank do credit analysis to make decision to approve or to reject the loan, to granted or to reject the loans. Okay, they will check whether the borrower is to ensure that the loan are good loans if they lend to the borrower or not. Okay, to ensure the loans are good loans, they need to ensure the creditworthy of the borrower, whether the borrower is good credit rating or not. So it requires 6 Cs. And then whether there is enough protection of fund to the supplier, meaning enough protection to the depositor money, because bank lend the money or lend the loans using depositor money. Okay, so they need a proper documentation. Maybe they also ask for collaterals. Okay, if the lender fund they cannot cover when the loan defaults, so at least they can use the collaterals to get back their money. And to doing credit analysis, okay, when doing credit analysis, basically bank try to get the answer whether the potential borrower, whether the borrower have ability to pay and also willingness to pay. Okay, ability to pay, where they get money to pay back the loans, where are their source of income, okay, whether the income are adequate to pay the loans, okay, that is ability to pay. Okay, not only focus on the ability to pay but also willingness to pay. Some of the borrower, they have ability to pay but they are not willingness or not willing to pay. For example, like case that's study loan borrower, okay, after they have ability to pay because their work, after graduate their works, they are working but they did not pay the loans, so meaning they are not willing to pay back the loans. So bank need to ensure when they do credit analysis, they have the borrower ability to pay and also willing to pay. Okay, so how bank check on their credit analysis? Okay, basically bank will check on these 6 C's, okay, when doing credit analysis, but not limited to this. Okay, most of the bank focus on this and there may be the subjective justification. Okay, what is 6 C's? Character, capacity, cash, collateral, condition and control. What means by character? Bank will check on the specific purpose of loan and the serious intention to repay the loans. Okay, especially for the business loan borrower. Okay, when they apply for the loan, they mention they aim to get profit how many, and then they give proposal to bank and then required for certain amount of loans. Okay, so maybe what bank can do, bank call the potential borrower and interview. From that interview, from that bank can know their characteristics. Okay, sometimes from the purpose of loan itself, bank can check on their characteristics. Okay, and the next C is capacity. Okay, what is meaning capacity? Basically is related to legal authority to sign binding contract. For example, did the potential borrower have capacity to borrow loans? For example, they want to borrow, a borrower, a customer want to borrow car loans. So they should have capacity, for example, show the driving license, okay, and the age 18 and above, okay, and then if the maybe they need to show they are resident of Malaysia. So this is about whether the borrower have a legal authority to sign contracts, the loan with the banks. Okay, next, the most important is cash. Okay, what is the meaning of cash? Bank need to check whether the customer have ability to generate enough cash to repay the loans. Okay, for example, they want to borrow 100,000. Yeah, they have a salary, they have cash, but whether the monthly cash income can or afford the monthly payments, okay, the monthly loans payment. So or the they should have other part-time income that can cover the monthly salary to cover or to pay the monthly installment. Okay, so bank will check any support document, any proof to show that the customer have ability to pay their loan repayments. Okay, the fourth one is adequate asset to support the loans. Okay, okay, based on the cash. Okay, and then bank also can check the collaterals. Okay, maybe some of the loan bank require collaterals. Okay, collaterals, for example, if usually it's about 70% or 80% of the loan amounts. Okay, so if the customer provide collateral to get the loans, so they need to check the quality of collateral, marketability of the collateral, the collateral itself, the character of the collateral, whether the value of collaterals, characteristic of collaterals can support the loan if the loan defaults. Okay, the next is conditions. What is the main conditions? Condition meanings relates to economic conditions. Okay, for example, if economic change, can borrowers still pay the loans? Okay, if the economic change, interest rate increase, higher interest rate, can borrowers still pay the loans, the monthly payments? So if anything happen to the economic condition, can the borrower still manage to pay the loans? Lastly, about the controls. Control basically related to the loan requirement, loan regulations. If anything happens to the regulations and affect the change of the monthly loans, okay, uh, can borrower still pay the loans? Okay, so the difference between condition and control is condition, anything changed, economic changes, whether it affects or not borrower. Control is about anything change the regulation of the banks. Okay, can borrowers still pay the loans? Okay, so how bank do their credit analysis? Okay, credit analysis not only focus on the borrower itself, they also focus on the loan size. Okay, the amount of loan size. Okay, for example, 100,000. Can the borrower pay the 100,000 loans? Okay, and check also the loan tenure. Borrower request for the only short-term loan tenure. When the short-term loan tenure, can borrower pay the high monthly installment? So the cash or the salary that borrower have, can they pay the higher monthly installments? And of course, for the business borrowing, uh, they also check on the company records, the performance of the company. Sometimes they check from the customer, the supplier of the company, information about the company. They will check on that. Okay, and then the previous relationship with the bank, whether the borrower have a good relationship with the bank, for example, a good borrower, or they have problem in previous loans. Okay, so they also check on this. And also usually bank, if the regular borrower, maybe they can offer, they are easily to lend the money to the borrower because borrower is good, and then they keep borrowing. After finish the loan, they keep borrowing, so bank can uh, approve the loans. Okay, and then collaterals. Okay, that I mentioned, we will learn about collateral in the next chapter. The characteristic of collateral, whether collateral value, liquidates, okay, marketability. So they will check on this when they are due credit analysis. Okay. Okay, when they do credit analysis, they need to refer from the several source of information, not only documents that the borrower supply, but also they gone beyond that. Okay, sometimes bank call for interview. From the interview, bank can understand the characteristics, and then the ability of the borrower to pay, and then understand whether they can achieve or not to pay the or to get their income to pay back, especially for the business borrower. They propose their potential income. So from the interview, bank can know whether they can achieve or not their potential income to pay the loans. Okay. Bank also can check the bank records. Okay. They can check with other banks. Okay. This one also sometimes for the business, they can check the business transaction if the business has the accounts with the banks. Okay, so they can check. They also can check with other banks. Okay, inspection. For example, like business premise, you apply for the business loan. Possibility bank uh, go and visit the business premise to ensure whether the business exists or not. Okay, and what product they do. Sometimes they apply for business cake, bakery, but actually their business are related to the printing. Okay, so they want to confirm, okay, the purpose. Okay, of course they will check about the financial statement of the business, or maybe the account for the household borrower, or EPF statement also. Okay, to check about the cash flow. Uh, to pay back the loans. And rather than that, okay, bank also check on the credit bureau, okay, the insolvency bureau, CITOS, SICRIS. CITOS, SICRIS is the system. RAM, rating agency measure. Okay, the next slides we will talk about CITOS. What is actually CITOS? Okay, so basically, I hope you can read the rest of the slide is related to the CITOS. Okay, what CITOS functions. Okay, so the reason they check on credit bureau to check about the transactions. Okay, how many credits the borrower have already in the current with other bank, with other institutions. Okay, so these all credit informations they gather when they are do credit analysis before they make decision to granted or to reject the loans. Okay. Okay, basically what is CITOS? CITOS, SICRIS, okay, you can read this. Please read the whole until last slides, okay? You can read. In conclusion, CITOS only a system that showed about the credits, whether the payment, whether there is outstandings, okay, on the whole financial institutions, okay? For example, you want to check CITOS about yourself. If you already have borrowed some things, how credit loans, I mean, for example, like study loans, when you check your CITOS, your name, and how much loans, and whether you pay or not, whether you have outstanding or not, okay? So there is a just information collector of information, okay? However, the CITOS are not rank you whether you are good borrower or bad borrower, whether your credit rating is low or not. Bank will decide on that. CITOS just give the informations, okay? Based on the information, they make decision, okay? Whether to rate you good or not. Okay, thank you.